Welcome, everyone, to today's Independent Advisor panel. I'm Michael Finke, a professor of wealth management. 2022, I think we faced so many unique aspects of the market. We faced a situation where many bonds fell in value, stocks fell in value at the same time. That certainly created a lot of anxiety, and I think a lot of clients had questions about how to react to that decline in asset prices. As an investment advisor, how are you managing that client response? What's going on with your clients, Scott?
There's a lot of anxiety. We try to spend most of our time hitting this off at the beginning of the client relationship. So when we set up portfolios at certain risk levels, we try to explain to them what a normal correction and what a crisis would look like, so that when we try to repeat that to them in client reviews, so that when they see this coming, they're more prepared for it. And so, yes, we're getting a lot of calls, but we're also getting a lot of calls of people coming in because they thought every advisor was doing a great job until all of a sudden we hit these market volatilities. So we focus mainly on getting them really educated up front on range of outcomes so that they're prepared for it when it comes.
Now, Andrew, speaking of educating your clients, you have some clients who are maybe not as experienced with investing, and we've had a 10-year period now, more than a 10-year period, where the markets have pretty much steadily gone up. What do you do when you have a client that is a little less experienced to get them to anticipate that loss is part of the game?
Yeah, I think the conversation on the front end, explaining what risk tolerance looks like, what the range of outcomes looks like, is great. But we all know the human side that, you know, Mike Tyson said everyone has a plan until they get punched in the face. And so a lot of people got punched in the face this year. And I think it's more important, the charts and graphs are great. But really to uncover what the fears are, what the question is behind the question, and then educating folks around how we've already planned for this. I think it's also important for newer investors to give them more control over their outcomes, right? Giving them a range of options that they may take a little more or a little less risk, or they may take a little more risk, but they feel like it's their decision. And usually we can come somewhere in the middle where we can still maintain a successful outcome, but we can also have them sleep a little better at night.
So what is it that you do to get them to imagine? You said that it's all part of the plan,
yes,
that you're going to lose money every once in a while. What sort of language do you use with a less experienced investor to get them to feel more comfortable, to know that it really is part of the plan?
Yeah, I think we're all human beings, and managing uncertainty is part of the game. I think we've gotten into a space where people want to sell certainty, and I think we're just more upfront that certainty isn't a given. These are not things that we can assure will happen. But with all of the best minds in the market, and with us as your guide, your Sherpa, if you will, we're going to get to the right destination. And so, yes, there's range of outcomes. Yes, there's asset allocation. Yes, we'll talk about the diversity of geography and the diversity of assets and diversity of time horizons. But at the end of the day, we're there with you to walk through this. Everyone in the United States and abroad are experiencing this, and you are doing the things that are really critical to be successful when it comes to saving, when it comes to how you're doing your behavioral side, and just trust us that we're doing what's in your best interest on the back end as well.
You know, I know advisors have been criticized in the past for putting a pretty face on risk, for making it seem like markets are always going to go up, that you know, if you just have a long-term time horizon, you don't have to face the possibility of loss. But that's part of the gamble, isn't it? It's part of the game. If you take risk, then you have to accept the downside. So, Angie, you also have clients who are maybe a little bit less experienced.
Yes.
What approach do you use to get them to handle risk?
So, Michael, really we talk about the downside first. So if I'm talking about the downside and we're not talking about performance, because a lot of advisors, I think, focus on, getting the gains and the performance, so that when the downside comes, now they have to walk it back a little bit. Versus my philosophy is, if we are protecting on the downside, then the upside will come. That's a natural occurrence in the market, that there's recovery. So let's focus on what the downside looks like and how we protect on the downside. What are you willing to give up? What are you willing to do differently when that downside comes, whether you're pre-retirement or in retirement, having that secondary plan, that downside plan, so that there's no fear factor, because you can sit back and say, we planned for this. we plan for this.
Now, Angie, what are some of those strategies that you use to make sure that the client's downside is being managed?
So then we look at what the risk tolerance is, right? What are they doing from a risk perspective to cover? So maybe we're looking at some specific products that may be out there specifically to cover risk. Looking at a life insurance product, looking at an annuity product, looking at all those things that may cover some of those really basic needs that they want to have covered. So if we cover those and they're comfortable with that, then the next side of that are what are the discretionary things that you want to do? And are you willing to downsize those discretionaries or turn them off altogether? So everyone's plan B is a little bit different, and I tell them that. We're going to work on your specific plan B as it pertains to your goals, time horizon, risk.
So Heather, you have a clientele that is perhaps a little bit more experienced in general. For them, some of these strategies may be a little bit different than the strategies that your firm uses with their clients. What is your approach to helping clients understand risk and then putting together a plan that manages it?
Absolutely. I think it comes back to bringing it into the context of a financial plan, because a financial plan really helps you understand what are you investing for. It allows you to extend your investment time horizon when you understand where your cash flow needs are going to be coming from. And then the specific strategies to implement that plan look different for everybody. Certainly making sure that those specific risks that Angie mentioned are covered. It may make sense to look at life, long-term care, disability insurance, annuity products, and certainly managing things on the tax side of the equation. That we may introduce strategies such as Roth conversions. While it may seem painful to pay the taxes, down markets can really be an opportune time to do that conversion and then capture the appreciation in a tax-free environment on the upside. You can potentially pair that Roth conversion with a charitable strategy if people are philanthropically inclined to offset that tax hit. So really understanding what matters to the client and then selecting the strategies that are best for them.
You know, I really like that philosophy of using a down market as an opportunity for new planning strategies and helping to frame it for a client as a positive, as opposed to simply framing it as a loss, by opening up opportunities to do a Roth conversion, to give money to charity with using assets that have been devalued. It is an interesting approach, and I think that clients probably respond well to it.
It does seem to be well received when you can turn around and make lemonade out of lemons, when you can turn that volatile down market into an opportunity for somebody to continue to progress toward their goals. Really, I think financial planning at its core is about establishing that pathway to financial success, regardless of the variables that are outside of our control.
Now, Scott, I'm going to guess that you've also had similar types of conversations with your clients. You also tend to work with a higher net worth clientele who may be more charitably inclined in general. What are some of those planning opportunities that you took advantage of during a down market?
I guess the first thing we do really is focus on where you're going to spend your money first. People get through market volatility a lot easier when they know how they're going to pay their bills for the next year or two. I think the biggest opportunity you have now is when you're mapping your liabilities or what you need to spend in the next few years, you actually get yield now. So, you know, the Treasury, short-term Treasury yields were like less than 1% for years, and now they're over 4%. We do tax loss harvesting during this time. We take appreciated stock and gift it. We do those things in charitable planning as well. And we try to do gift stacking so that now with the new rules, you can gift stack and maybe do one big charitable gift every 4 or 5 years or something of that nature.
Now, you mentioned the fact that we're in a higher yield environment.
Right.
Tell me about some planning strategies that opens up for you.
Well, 60-40 becomes not dead anymore.
Yeah.
I mean, before we were trying to really use some alts and things of that nature, cover call strategies, hedging strategies of that nature, and we outsource most of that stuff. But now that you can build a portfolio of treasuries or less risky assets in the short term, we can get back to old academic portfolio management versus being guilty of stretching for yield and taking in classes, maybe taking more risk than we would like on moderate and short-term buckets of the plan.
You know, I think about the beginning of 2022, and there were a lot of clients that were upset about the returns that they had been getting on their bond portfolio. And I think a lot of advisors felt pressured to stretch for yield either through longer durations or taking more credit risk. And we all saw what happened in 2022. It was a good reminder that stretching for yield in a low interest rate environment is not always the best idea. And I think a lot of investors were punished for it. A lot of advisors perhaps took more risks with the fixed income portion of their portfolio than they would normally have taken simply because we were in such a low yield environment.
Sure, and what we found is what we were trying to do when we were managing the portfolios is constantly rebalancing. As the equity gains were going up, sometimes we were spending those and rebalancing to get the risk factors or risk alignment back where we want it. Now we're done the reverse. Now we're starting to spend short-term assets and try to hope that the equity assets come back.
Yeah. Now, are you moving out the duration of your bond portfolio now?
Not now. As of today, the 10-year Treasury is just over 3.5%. We might have done that 6 to 8 weeks ago when it was pushing up around 4, bought a little bit of duration. But now what I've done more than I have in almost my entire career is we're buying a lot of 3, 6, 9, 12 months, 2-year Treasuries to just fund those short-term needs. We know that clients, when they know how they're going to spend their money, they know there's a safety sleeve, and they know they have confidence in it, they tend to be a little more patient and letting their long-term assets realize their gains.
Now, Andrew, I know even for lower income investors, these higher yields, and especially if they're risk averse, they open up many more opportunities on a range of investments and insurance products that may not have existed a year or so ago.
Yeah, absolutely. If we think about, and you're saying in lower income spaces, and I've heard some really great conversations about charitable. What I found is that clients are still financially savvy, and income-based clients are still a lot of times the charitable ones in their community, right? We have our definitions of high income and high net worth, but those aren't always the same inside of a community. I found that at certain levels, they're still giving at a higher percentage, and so we can do charitable giving in a really impactful way. $10,000 might not seem like a big deal, but if they're one of the largest donors in their church, it is. And so there are a lot of strategies that we can use, whether it be to offset taxes or whether it be to give them a nice thought process around safe money. Bonds and treasury bonds and I bonds with their yield in the last year have been great. The maximum was $10,000, but if that was the amount that you had, that was a really effective way to put safe cash away and get 7 to 8% over the last couple of months.
Right, and if you have a lot of money taken out of your taxes or prepaid on taxes and you get a refund, you can also add to that $10,000.
Fund it right there.
An interesting strategy. Now, Angie, you have a lot of clients who already have pension income.
Yes.
But I'm guessing that they're probably also pretty risk averse. For them, what sort of opportunities do you see in a higher interest rate environment?
It's interesting that they come from the perspective of, what can I do now? What does that look like in the future? And with all of the volatility and the interest rates, how does that all mesh with my goals and my view? And so we have to really sit down with them and dissect out what it is from a short-term, intermediate, and long-term perspective and their goals, because then that will lead us into some of the ways that we can manage each one of those time periods, right? And so I look at clients who have a pension and I say to them, okay, really what we need to be thinking about is the tax implication of what you're doing, because most of my clients are coming out of their first career, getting a pension, and going into their next career. So their challenge is going to be a tax issue. So how does that all play into into an interest rate environment that is constantly changing? Does it at all? And it may not play at all, really, because really their perspective is, I'm paying way too much taxes. So we have to answer that question first before we can even get to some of the other questions that may be on the table that they want to do, like charitable giving and those kinds of things. Because if they're giving away a portion of their dollars to Uncle Sam from a tax perspective, then we are decreasing their unallocated dollars that they may have to be able to do some of the things that, some of the strategies that we want to see in place. So we really have to manage it from a tax perspective first.
You know, it really is true that when they have a pension, especially earlier on in life, they have less tax flexibility. In other words, there are fewer opportunities as there would be for, say, a business owner who might have a low income year or maybe able to actually have a little bit of power over how they adjust their income over time. Your clients have this steady income that they always have to count on, which means that they may always be in a higher tax bracket.
Yes.
They may not have some of those opportunities. And we know that these safe assets that are providing investors with a higher yield right now are the most tax inefficient types of investments to hold. So what sort of location strategies do you use with those inefficient investments?
Again, looking at primarily probably their most current situation and how duration is going to play in that, right? I think to what Scott was saying, looking at 3 months, 6 months, 9 months out, right? What does that look like in a 2-year period of time? Because that's probably going to be your short-term period. So what does that look like for you, and what can we do to shore up that period of time versus intermediate and long? And what are you putting in place? Because many of them do not even realize, they've been taught over and over again, always put into your 401k, into the match, right? Okay, well, then what happens is there's taxation on the back end, right? So now, yeah, you're putting into the match and you're getting the match, that's a good thing, but now you're paying Uncle Sam on the other side of that. What happens if we reallocate that, or worse yet, they will increase their withholdings because their tax preparer may have said, you need to increase your withholdings. My first thing is, no, let's put that money back into your space and back into your pocket. It's coming out one way or the other. How about if we shore up your 401k so that you're making that more attractive and more attractive to you and less attractive to Uncle Sam, because it's pre-tax dollars that are going in there. And then I think, Heather hit the nail on the head when she said, and in this environment now, Roth conversion strategies are coming into play very well. So for those that have that ability to do that, let's look at that on top of it to be able to take care of, the long-term perspective on the tax end, on the back end, so that when you're upfronting your 401k on a pre-tax side to decrease your taxation, right, you're getting the best of both worlds on both ends.
So go ahead, Andrew.
Yeah, I do want to add on top of that, because the vast majority of our clients are high-income earning young professionals, right? We're finding that whether they're women or diverse communities, they're earning 2, 3, 4 times the national average, $200,000, $300,000, $400,000 a year. And their biggest goal, and they identified, is they don't want to work that long, right? We're chasing financial freedom in their 50s, early 60s in some spaces. And in that plan, the 401k is not their friend. And a lot of times we're finding that it's resonating more to put money in non-retirement assets, to go into the brokerage account, for us to, shift the allocation past the match to dollars that you have control over. We can reduce the taxes in those accounts by having, tax managed assets internally, but we can really talk about, you can have access to these dollars at 52. So if you choose to have a 30, 40% savings rate, which a lot of them are, if we can coach them into not inflating lifestyle and to actually tuck those dollars away, and we can move that financial freedom age from 62 to 58 to 52, and we can be really aggressive about it. And instead of maxing out the 401k or doing other additional pre-tax dollars, we go into the brokerage account and manage the tax. They love that. And it feels like they're taking control over it, and it actually incentivizes them to save more and invest more. And the dopamine hit that they get when the accounts are growing and bouncing back, it's wonderful.
Well, and I think there's a myth that's out there for the younger clients. I think that works amazingly well. But the interesting thing about those who are in their mid-50s and later, the thing that I hear all the time is, when I retire, I'm going to be in a lower tax bracket. That could be true, but my question for them then is, but do you want to live in that lower tax bracket? Well, no, I want to live with the income that I have today. Well, then that means pretty much so that you're going to be in the same tax bracket or higher, depending on what happens, right? So no, you can't plan that you're going to be in a lower income. You have to plan from the perspective of what dollars do you need available today. what does that look like in the future? And if you want $100,000 today, it's going to be more than $100,000 in the future. Don't plan on living in the 10% tax bracket. That's not realistic. That's not going to happen unless we take some strategies and put some strategies in place to make those dollars non-taxable dollars. Yeah.
You know, Heather, this understanding or being able to predict what tax rates are going to look like at different stages in the life cycle, that is an important part of planning, isn't it? It's an important part of locating assets in different types of accounts, when it makes sense, when it doesn't. But of course, there's a lot of uncertainty to that. What sort of strategies do you use at your firm to make decisions about when it makes sense to use a traditional IRA or a Roth, or use some sort of financial product, or invest in a brokerage account? When does it make sense? What sort of recommendations do you give to your clients?
Yeah, I think we're looking at, that long-term picture, because exactly what Angie was saying, if you know that people's expenses are going to continue at a certain level, you need to plan for that. And can we make the plan more successful by showing a scenario? Well, what if we allocate to, a Roth 401k rather than a traditional 401k? What does that look like? In this pre-sunset Tax Cuts and Jobs Act, while we have a few more years, we're talking a lot about bracket topping strategies. So knowing that, whether people are pre-retirement or going to be in retirement, chances are their tax rates are going to go up in a few years. No one has a crystal ball. We'll see exactly where it lands. But if we can go up to those top of those brackets while we have those lower rates currently, that's something that has some certainty in the short term that can set people up with some tax diversification in the future. It's wonderful if they've done a fantastic job savings. Many people were told to do that pre-tax. Maybe their plan added a Roth feature later. They hadn't thought about how to do it differently. So just introducing those conversations about, do we pivot on the form of savings, and can we use bracket topping to affect some change?
That 24% bracket is huge right now for a couple. It presents a lot of planning opportunities, and I'm not sure how many advisors really try to take advantage of that every year, especially before retirement. It's I think as you mentioned before, it's an opportunity that exists today, but it may not exist forever. And that 24% bracket is pretty attractive given how high some of those brackets have been for higher earners historically.
Absolutely.
Scott, what sort of strategies do you use for asset location?
Sure. We do a lot of threshold planning, just like Heather was saying. There's multiple things between Social Security and Medicare and all those. And but we try to project out the income streams. But in asset location, we really take a lot of time on this. And we look at putting, especially when we have all the assets and we can globally manage them, we're going to be really blocking and tackling very passive in the taxable account. We're going to try to generate very low income, very low interest, so that they just don't map much to the 1040. And if we have a great year to where they're in a lower tax bracket, have a big loss in a business or some kind of opportunity like that, we will take some gains and rebalance. On the flip side, when we look at their IRAs, and let's be honest, a lot of times when clients come to us, they don't come with us with this magic perfect portfolio or accumulation strategy. What they're really doing is coming with you, and you're starting from there. And if we do have a lot of IRA assets, that's where we're going to put your corporate bonds, your higher dividend payers, and your alternatives, cover call strategies. A lot of these active tactical strategies are very tax efficient. And so if you can show the client how much value they get from having those housed in the IRA, you get a better outcome. And that's where we lead to working with CPA firms. They really hate surprises. And so if they've done threshold planning and you're in a mutual fund that has a massive distribution that wasn't planned for, in my opinion, it's a client acquisition opportunity.
Yeah, you make the point that in a brokerage account, it really is those passive equity strategies that dominate. And if you have any sort of, even a partially active investment strategy, it might be better to locate that in a different type of sheltered account, whether it's a traditional IRA or a Roth or even some sort of an insurance wrapper. That is a way of reducing the amount of tax inefficiency that you get from those types of strategies. I think there's so much that an advisor can do to provide real value through asset location, as opposed to a lot of times advisors would think that asset selection is their primary source of value, but really the evidence isn't there, is it? That the security selection is not where the value is. Tax efficiency can provide ongoing value that is far more certain than being able to choose the right mutual fund next year.
What I would say is that a core of our firm is that we believe in owning equity for a long period of time. If you own equities for a long period of time, they tend to work out better in the scenarios. Your outcomes are much better for a long period of times, and people do need cash. But having the discipline not to incorporate taxes when they're unnecessary really helps the client outcomes. It's 30% or better of every situation.
For my clients, talking about the fact that they already have a pension, they're coming into maybe a Chapter 2, then, some of those allocations that would normally have gone to a tax-free account such as a Roth IRA no longer is available to them because they've incomed out, right? So now we have to look at, all right, conversion strategies come into play from that perspective of putting dollars into a traditional IRA and then converting those out over into a Roth IRA so that you're still feeding that tax-free vehicle so that you're having the dollars. Because a lot of clients, I don't think, understand how that whole mechanism works for conversions versus contributions. And again, working with a CPA or a tax preparer, a lot of times it's like the tax preparer might say, well, you need to take the money out, you're not eligible, right? Well, yeah, okay. My conversation with the tax preparer becomes, well, what happens if we recharacterize those dollars, put them in a traditional IRA, right? Instead of having them withdraw the money, relocating them to that traditional IRA, and then on the backside of that, converting them to a Roth IRA. So you're going to see it, tax preparer, you're going to see it come out, but then you're going to see it come back in at some point in time with that Roth conversion, and having the tax preparer understand the philosophy behind what we're doing so that collaboratively the client is seeing that the team is working in their best interest overall from a financially successful perspective, but also from a tax efficiency perspective.
Yeah, I agree with that a lot. When we think about the traditional Roth conversation, what I found is that, most clients do some research or they ask a friend or they ask a colleague, and then they choose how they want to allocate between traditional or Roth for 10, 20 years. And when we're finding folks going into retirement now, they've been going pre-retirement all of their lives. And they may have made that decision 1980, 1990, higher tax rate. It might have made more sense at that space. They probably didn't have a Roth 401k option. The exact opposite is happening now, right? When my clients walk in at 35 years old, it's Roth, Roth, Roth. Roth IRA, if they have Roth 401k, they choose that. But it's not a blanket solution. We have a client that we just worked with last week who she's earning $400,000. And she's been doing Roth, 401k max out for the last 3 to 4 years. She didn't start at 400 of income, but that's where she finds herself today. And we had to talk her through why 35% federal plus New York State plus New York City had her at about a 45% overall tax bracket, and that we actually wanted to max out her traditional. And it was a foreign concept at the time, and I was surprised that her accountant never gave her that piece of advice. But once we did that, we actually could show her long-term why it mattered, and it has to be nuanced like that. So I feel like people are really sometimes 5, 10, 15 years behind on the advice, and it makes sense. That's not what they do all day. And so it's our job to really help them with the most current information and with their most current situation.
And educate them, right? Because again, it's an education process. It's not just an action process. It's not just us telling them what to do, but having them understand the why of it. Because I think there's a part that says, if I understand the why of it, especially for women, which is a lot of who I work with, if I understand the why of it, I'm more apt to not only execute it, but keep in that path, right? Versus what's going on outside of, the noise of the landscape or, what's on television or what a pundit is saying. I understand the why of it for me and how this works for me, and therefore I'm going to stay this course. So that whole water cooler conversation tends to be moot.
The other piece that I see us contending with is inherited IRAs in the post-secure environment. And oftentimes people are finding themselves now having a 10-year window to withdraw those assets from the senior generation, often in their prime earning years. So if you have somebody who isn't maxing out their 401k, perhaps that's an opportunity to say, hey, let's take a little bit more from that inherited asset and go ahead, max that pre-tax option like Andrew was referring to.
Yeah, I agree. I feel when we explain not only the tax impact of pre-tax dollars on the back end, when we explain how it shows up in Social Security taxation, how it shows up in Medicare premiums, and then how it shows up if you were to arrive at the generational wealth space that you want to, and what those IRA dollars look like for the next generation, and how handcuffed they are with the current administration, a lot of times they absolutely choose to at least diversify into Roth or brokerage dollars so that they're not handcuffed on the back end.
I don't think clients even understand a lot of times what's going on when we're talking about Secure Act 2.0. They don't even understand what those component pieces are. Let's be honest, with Secure Act 2.0, I don't even think custodians understand what's going on, let alone some of our advisors out there. I mean, that's just so fresh and new, and 92 provisions, who can navigate that? So if we as advisors are trying to, dissect what's going on there, what are our clients doing? I mean, they're still back to Andrew's point. They're still back 10 years ago thinking about, okay, what's the difference between a Roth and a traditional? And now you're coming in, you're telling me there's a taxation issue, and I got 10 years to take out money from an inherited IRA. How do I navigate any of this? And I think this is the perfect opportunity for clients to say, and advisors to say to clients, this is why you have me. This is why it's important to have a financial advisor, if not me, someone who's going to help you navigate that. Because again, if you try to navigate it on your own, there are some pitfalls that you're never going to see. And my clients say to me all the time, especially now with inherited IRAs, Angie, if I wasn't coming to you and you weren't helping me with this, how do other people manage on their own? It's too complicated. And so I think that advisors have an opportunity here to really come in and help clients tear apart what's going on the landscape, look at it from their lens, the client lens, and then build their financial plan going forward that way.
I'd like to thank everybody for joining me today for today's panel. It was a wonderful conversation. I look forward to continuing this conversation in the future.